Today's earnings really highlighted how companies are taking on heavy physical burdens just to bypass their own growth bottlenecks. Looking at the window for Tuesday, May 19th, we tracked Keysight, Home Depot, and CAVA. And it feels like the big takeaway is people are aggressively absorbing costs right now, whether that is an unexpected AI infrastructure bill or intentionally eating inflation to buy foot traffic.
Yeah, the headline numbers today were frankly, a bit of an illusion across the board. The real stories were physical. Take Keysight. Supplying the AI boom is actually forcing secondary hardware providers to spend huge amounts of cash just to keep up.
Right, because their AI validation business in just the first half of this year eclipsed all of 2025. Tech giants are frantically testing these massive high-speed optical AI cables, and Keysight physically just does not have enough equipment to handle the volume.
So they were forced to unexpectedly hike their own corporate capex by 25% mid-year just to build the testers. And a quick reality check here. They posted a massive GAAP profit, but it was highly distorted. A Supreme Court ruling on international tariffs artificially wiped $93 million off their cost of goods sold.
So underneath the paper profit, it is an incredibly expensive physical scale-up, which honestly links right into Home Depot. They are physically altering their own supply chain to find growth in a slow retail market. They acquired an HVAC distributor called Mingledorff's, not to buy out a competitor, but to cleanly bypass local distribution laws. Regional wholesale licenses just do not apply to replacement parts. So Home Depot is injecting this local inventory directly into its national logistics pipeline, and they instantly unlock a $100 billion addressable market.
It is a brilliantly clever loophole, but it is not cheap. Digesting that M&A debt actually dragged their gross margins down and forced management to formally pause their stock buybacks.
Which means you cannot artificially prop up the EPS. You are at the mercy of actual operational flow-through. But speaking of taking a hit to find growth, look at what CAVA did with their pricing strategy today.
Oh, this is my favorite piece of the batch. Most fast food right now is squeezing consumers to protect margins. CAVA went completely offensive. They explicitly refused to hike menu prices to offset rising food and fuel costs.
They deliberately ate the inflation, and by holding prices flat, they captured a massive 6.8% spike in foot traffic. They're actively pulling the exact low-income diners fleeing traditional full-service restaurants.
And the algorithm might see their headline and panic because net income actually dropped year over year, but that was a total illusion. The income drop was exclusively tied to a lower tax benefit on equity compensation. Underneath that, the core business is surging.
They are even heavily building out middle management, adding assistant general managers to half their stores to protect that volume.
What I'm watching next is how far these limits stretch. Keysight's equipment order backlogs are pushing into 3 to 6 month windows, which is a real cancellation risk if data center builds stall. And for CAVA, since they gave up price levers to win traffic, they have zero cushion if raw customer volume suddenly dips.
The trade-offs are definitely getting sharper. The individual company episodes in the feed have the complete call-by-call details unpacking exactly how these operational supply chains and structural retail ships actually work. But that's our daily summary. I'm Susie.
And I'm Miro.
Talk to you next time.